Last year, we titled our 2022 outlook Pulling in Our Horns, as we saw slowing economic growth and a less friendly Fed. We suggested taking risk off the table. We had anticipated that we would be putting risk back on over the course of the year. Instead, we ended up removing more risk as much higher than expected inflation, compounded by the war in Ukraine, put the Fed into rally-killing mode. And kill the rally they did. By the middle of the year, we entered a bear market, one that was really hard to escape from as it took down both stocks and bonds, pretty much around the globe. But bear markets do spell opportunity, and where valuations allow, we are becoming more opportunistic. We titled our 2023 investment letter, Preparing for Opportunities to Knock, as we expect buying opportunities to develop. Actually, opportunities have already started knocking. We just think more will come. As interest rates rose, we added to interest rate risk by moving out duration and are now overweight duration. After a major sell-off in fixed income, we're finding attractive yields, something we haven't seen in more than a decade. Small and mid-cap stocks are the cheapest they have ever been on a PE basis using the S&P indexes. We see plenty of opportunity there. And emerging markets, after a meaningful drop and with a lot of bad news coming out of China, they are looking much more attractive from a valuation perspective. And now, with China beginning to relax their zero COVID policy, we had the catalyst that we used to move to an overweight. Now, all that said, we still have some rough roads ahead. The global economy is slowing, and many countries are likely to fall into a recession, including our own. Some parts of the market haven't adjusted to this backdrop. The S&P 500 has moved down in price, but is nowhere near past bear market lows. We believe there can be more room for market dislocation where earnings expectations appear out of line with deteriorating economic growth. International developed equities look interesting on a valuation basis, but there is still a lot of fundamental risk as their central banks are in a bind trying to fight higher food and energy prices with higher interest rates. And then with regard to credit, below investment grade credit spreads remain below the historical average. So we're seeing some opportunities right now, but believe more will come during 2023. For more of our market thoughts, please look for our investment letter at touchstoneinvestments.com.
This commentary is for informational purposes only and should not be used or construed as an offer to sell, a solicitation of an offer to buy, or recommendation to buy, sell, or hold any security. Investing in an index is not possible. Investing involves risk, including the possible loss of principal and fluctuation of value. Past performance is no guarantee of future results. Please consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. The prospectus and the summary prospectus contain this and other information about the funds. To obtain a prospectus or a summary prospectus, contact your financial professional or download and/or request one at touchstoneinvestments.com/literature-center or call Touchstone at 800-638-8194. Please read the prospectus and/or summary prospectus carefully before investing. Touchstone funds are distributed by Touchstone Securities, Inc., a registered broker-dealer and member, FINRA SIPC. Touchstone is a member of Western Southern Financial Group. Copyright 2022, Touchstone Securities, Inc.